Thank you, Chair, and thank you, Professor Ndulo. Thank you, Steve. And let me also just thank you for making time to come and be part of this symposium. I will not spend much of your time, but here we have a study that we're trying to develop in the context of the Zambian banking sector. We heard earlier just how Zambia has evolved economically, but also in terms of trying to find probably what one would call a growth formula, as in to ensure that some of the pronouncements that the governments, successful governments have made come to fruition. So a number of reforms have obviously been undertaken over the course of the years, and one important aspect of these reforms is the changes to the banking sector and how banks allocate their resources in the economy. So that is one aspect that we're trying to establish in this particular paper. This is a work in progress, so to speak, and so we'll be very grateful to elicit as many comments as we possibly can receive from the audience, and is being co-authored with a colleague of mine, Lorena Pla. The structure of the presentation is just to give you a feel of what the Zambian banking sector is like. Specifically, we'll highlight on the reforms that have taken place over time and the current state of those reforms and why we are focusing on the credit concentration in the Zambian banking sector. Almost 20, 30 years ago, the Zambian government embarked on a wide range of reforms from the 90s, which were probably, maybe one can best describe them as a shock treatment, so to speak, because it was really a wholesale of reforms. There are colleagues here who have done some of the work and they better understand the nature of reforms that were undertaken during those years. Mainly, they were meant to dilute government intervention in all spheres of the economy, including the banking sector in terms of prescribing how credit should be allocated and so on. And so interest rates were removed, exchange controls were revoked, and a number of market reforms were also undertaken. In particular, the auctioning of treasury bills to facilitate liquidity control as well as financing government needs, rather than seeking recourse to the central bank. A subsequent wave of reforms, mainly arising from the banking crisis that took place in the mid-1990s, was basically aimed at strengthening the supervisory code, improving payment systems, and also there were additional changes to the foreign exchange market. The last bit was undertaken in 2003, which introduced what they now call the broad-based foreign exchange market. And then the phase 3 and 4 are basically building upon the initial set of reforms, targeting specific areas. And currently, of course, there have been a number of changes that have taken place. Those of you that follow the market very closely, you've also seen reversals in those reforms, which also tend to affect how market players respond. Currently, the central bank and the government in general is undertaking what they call financial sector development plan number 2, which is basically targeting financial literacy and improving access to the banking services in general. But one key area that really is of major concern is that the banking sector in Zambia remains very concentrated. And over the past few years, we have seen an increased number of foreign banks. But even with that, it has not been able to dilute the amount of, the share of the largest 4 commercial banks in Zambia. So this has been one of the sticking points. And so, although competition is low, there has been some signs that it is now improving especially with the emergence of new banks from about 2008. But banks are also characterized by high operating costs, wide interest margins, and as I said, the last set of reforms is really targeting financial sector development. This is mainly because of lack of low financial access arising, for instance, from cost of credit, but also other usury charges. Why do we focus on the sectoral credit concentration? Is banks in Zambia and many other developing countries in particular account for a larger part of financing businesses. In Zambia, for instance, commercial banks command not less than 90% of total financial sector assets. And like I said, banking finance is the main source of financing. There's a foreign exchange, the capital market in Zambia is very thin and is still not very well developed. Also, similar to the study that we saw a while ago, at least in Zambia, we have not seen a study of this nature. Neither have we seen a similar one undertaken in Africa. So we believe that with this paper would provide some new insights into the understanding of the credit concentration in the banking sector. That will also aid in how regulators conduct their policy in terms of analyzing bank performance and risk. So Zambia really provides a very fertile ground, given the background of the reforms and the changes that have taken over time. It provides a basis for us to investigate the market. Over the past decade, again, I go back to the introductory piece about Africa in general, but focusing on Zambia is that Zambia really has seen significant growth in its GDP, averaging above 6% over the past decade. You can see it from the blue line. But also inflation has been on the decline from the highs of 30% in the early 2000s to now below single digit. Yes, of course, the past year and the current environment now, we have seen an uptick in inflation, and those fears are really are being closely monitored by the central bank. In 2011, Zambia was classified as a low-middle income country by the World Bank, and I think that brought some relief, but also it brought challenges on how the country can sustain the growth and also broaden the base of economic benefits. Basically, the conducive environment that we have seen in terms of policy and growth has also been translated in investor response. And here we have seen what many have really touted as one of the best Eurobond issuances of the past few years, where Zambia raised about $750,000 with an order book of about $12 billion. And recently, about a month, 2 months ago, they issued another $1 billion, but this one came a little bit more expensive, largely because of the issues that I've talked about, reversals in policy and other things that investors look at. But also we have seen increasing investment, mainly attracted by the booming mining industry. Zambia is a copper country, and so if the copper industry is doing well, generally investment in the country tends to be high. So I'll skip a few of these things that are basically just trying to explain the developments in the economy. Let me just give you a few stylized facts for the banking industry. And here I noticed only this morning that the chart is not different. I think it's a question of copy and paste. So in the flash that I have there, I have since corrected, but I didn't have time to make an amendment to this. But one thing we can note is that profitability has been generally favorable until the onset of the global crisis, which kind of squeezed in bank returns. But from the chart that is not here, we see that the interest margins are also very wide, which probably explains why banks in Zambia are generally very profitable. And you could see the differences between local, foreign, and public in terms of performance. And here also lending has been going high in Zambia relative to, with a slowdown in the purchase of securities, mainly because government has been, until recently, retrenching its borrowing from the central bank, from the banking sector. And that's why we saw an uptake in bank lending as a share of total deposit. But even with this, Zambia still remains below its comparator and the regional peers. You can see from the stacked line there that Zambia lies below both sub-Saharan African low-income countries and even lower middle-income countries. So really, we have not done much to basically ensure that there's enough credit flowing to the private sector over the time. Here is just to give you a snapshot of the share of assets. I talked about the large four foreign banks which command more than 3/4 of bank loans and about 70% of assets. Here is just to give you a feel of the nature of the interest rates, and you could see that they've been decreasing over time in the past years. But in terms of lending, the rates are still very high. Like I said, this has also contributed to shutting many people out of the credit market. Much closer to what we are looking at in this paper is the concentration of credit and the share by bank size. And we see here that the small banks, so to speak, the large banks have had a large share of credit, which is not surprising, like I said. And this basically cuts across a few sectors, not necessarily across all the sectors. And we see this heterogeneity spreading over to the recent evidence as well. But there has been some also improvements in terms of small banks acquiring some of the market share, particularly in areas that the large banks are not very prevalent in. And here we have also seen an increasing share, which I think is something that we need to emphasize here, an increasing share of lending to individuals and households. And you could see that it started mainly from about 2007. This is remarkable. Why? Because 2 years prior, basically 2006, so to speak, Zambia's credit profile completely changed with the HIPC debt relief, and this brought a lot of optimism in the credit market. But also, interest rates collapsed almost to levels that individuals could now afford. And so there was also a push towards lending to this sector, and you could see the squeeze in lending to the private sector, as the case may be. But also, like I said, retrenchment of government borrowing from the commercial bank has also reduced over the past few years. Our study really is influenced by some of the pioneering works in terms of Diamond 1984, but also just to note that the concerns about concentrated lending are mainly related to issues of risk and how this also affects the returns. And recently we have seen an increasing number of studies, mainly, like I said at the beginning, in industrial countries. And much of the literature that I've cited here have used the traditional measures of sectoral credit concentration. And here we're talking about the Hirschman-Heffindow index, which is very common, and many of you know it, and also the Gini coefficient, which also tries to measure inequality, both in income, for instance, but also when applied to banks, it does depict the nature of inequality in credit allocation to individual banks. Recently, there has been an emergence of what they are calling distance measures. These basically rely on some benchmark where the benchmark could either be the sector's share in value added or sector's share in total lending to the banking sector, or the share of employment in a particular sector is what is used as a benchmark. And that's what we are depicting there by row. But also, S here, we define it as the lending share in a particular sector relative to the bank's overall lending. There have, of course, been variants of these two measures in some of the studies that we have cited here. One is for the German banks and also recently by the Irish banking sector. So in this paper, we measure credit concentration using the HHI, the Gini coefficient, and the ADM and RDM. We have also measured it by entropy, but the results for this are not included in this presentation. And also, we now would like to relate credit concentration to bank performance to see whether the bank's specialization or focus does affect its performance in terms of returns, in terms of risk, and so on. In this exercise, our focus is mainly on the returns, and here we measure our returns with return on assets. And then we have the CONC is mainly individual concentration measures. And then we have individual, we have market variables and as well as bank-specific to control for variations in the bank's size and so on. We fortunate for one reason is that we have access to a large data set also spanning about 10 years on individual banks' credit composition for about 13 banks. Of course, in the course of the study period, we've seen some measures, but also entry into the sector of new banks. But the new banks really account for only about 6%. So we exclude them from the analysis as well. And also in terms of industrial sectors, we have about 13 industrial sectors, but only 6 of these industrial sectors, that's manufacturing, agriculture, mining, construction, and wholesale and trade, account for about 80% share. The remaining 7 or so account for the 20%. So the remaining 7, we've grouped them as what we are calling a synthetic sector or a composite sector, so to speak. And this is basically in line with the literature and so on. And so we also focus on the non-financial sector, which in this particular case, we are looking at the lending to the private sector, individuals and households. And we include here parastatals or public sector enterprises for one reason, because many of the public sector enterprises are either involved in energy, in agriculture, support to agriculture and food security and so on. And so their activities really are meant to support economic activities in the country. So we include them as part of the private sector, non-financial private sector. This is what we find in terms of the evolution of credit concentration using the concentration measures. Let me start with the 2 traditional measures here, the HHI and the Gini coefficient. And we see, just maybe to give you a feel, a higher Gini and a higher HHI denote increasing concentration as we know, and a lower value depicts decreasing concentration or increasing diversification, if you will. Conversely, for the ADM and the RDM, we see a decrease does denote increasing diversification, and an increase is also increase in concentration, as the case may be. So here, you could see that the picture that is emerging from the 2 traditional indices is really very symmetrical. Until about 2009, we had seen a rising concentration in banks lending to the private sector. but also the crisis, the global economic crisis, kind of pushed the banks to restructure their lending with spread of lending to other sectors, as we can see the reduction, a drastic reduction in the concentration indices. And this is for both. And this is also mirrored by the two distance measures that we find. And for the RDM, the change is even more sharp compared to the absolute distance measure of concentration. Basically, what this says is that in both cases, the evolution of credit concentration was punctuated by the global financial crisis, but also steeper, like I said, for the RDM than for the ADM. And this is also supported, in a sense, by visual inspection of some of the data that we have at our disposal. We have also tried to isolate credit concentration by bank classification, and we note here that large banks are mainly less concentrated than the small banks. In other words, large banks are a little bit more diversified than smaller banks and medium banks, but also this depends on which index you are using. If we look at the GNI and the HI, the medium banks tend to perform better with the GNI coefficient than with the other indices. Also, we see a similar picture for the two distance measures. For large banks, they show more diversification, both in terms of the absolute measure, but as well as the relative distance measure. And we see here again that medium banks and smaller banks are more concentrated than smaller banks. The picture about ownership really is more or less like a mirror image of the size. And this is because there's membership overlap, so to speak. For instance, in the large banks category, we also have a whole bunch of foreign banks, the 4 large banks that I talked about. So this is basically replicating what we have, and one may not necessarily see a major difference in that. This is basically just explaining what I've just talked about. We've also tried to just relate the share of loans, and we use the HHI to see where does the credit flow mainly and how does that fare in terms of concentration. And we see that the energy sector, although it receives little credit relative to the whole industry, it is probably the most concentrated sector. In other words, banks, there are many banks lending to this sector, even though the actual lending is smaller relative to the overall lending. In contrast, for the agricultural sector, we see that its share in total lending is about 20%, but it also has the largest number of banks lending to this sector. The outside that we have there is basically the composite synthetic sector that I talked about, and that's why we see a large proportion of a share of loans to that sector, single sector as it is, but also it shows that fewer banks basically lend to these composite sectors that I talked about. In terms of performance, this simple experiment that we have done here with the fixed effect regression equation, you could see here that, and we've done for the 4 concentration measures, we see that the HHI and the GNI do not perform as robustly as the two distance measures, particularly when we look at the variable of concern here, which is the concentration measure. For the HHI and the GNI, we do not see any significant relationship in terms of concentration and return on assets. It's different for the relative and the absolute measures, these distance measures, where we see a considerable and significant relationship between the concentration and bank returns. Like I said, we're still trying to understand the details of this relationship, and we will continue to maybe test more robust models to see whether this result can be replicated in other experiments. So what we find from here is that we show that except for the traditional measures, of course, concentration of credit is beneficial to bank performance as it is, and this is mainly for distance measures than for for traditional measures. But also we think in the course of further analysis, we would want to test how concentration does affect risk, particularly if also there is an important bearing on risk. But also we note here that regulatory burden, especially measured by regulatory capital, does affect bank performance. And this is important because of the recent changes that have been made to the banking industry, where capital requirements have been raised and tied between domestic banks and foreign banks. Foreign banks now have to hold capital about 4 or 5 times higher than in domestic banks in the Zambian sector. Really, I just want to end here by saying that Zambian banks and the industry as a whole has come of age, of course, since the crisis of the mid-90s, but also there are issues that need to be addressed. And in this paper, we're trying to assess how credit concentration has evolved over time and how this affects bank performance. Thank you very much, and I'm sorry I took a bit of time.